trade that hurts your account the most is often the one you never needed to take. Think about that for a moment. Not the big loss, not the obvious mistake. The trade that quietly drains your progress is the extra trade, the one taken out of boredom, impatience, or the feeling that you should be doing something. Every click feels small, yet somehow, at the end of the month, the account tells a different story. Have you ever noticed how your best weeks often contain fewer trades than your worst weeks? That isn't an accident. The market doesn't pay you for activity. It pays you for being right at the right time. But somewhere along the way, many traders begin measuring effort by the number of trades they take. They sit in front of the screen for hours, searching for opportunities, and eventually the search itself becomes the reason for entering. The strange part, the harder they try to force profits, the more profits seem to move away. Why does that happen? Because every trade carries a cost. Not just commissions or spread. Mental cost, emotional cost, decision-making cost. The more decisions you make, the more chances you create to make poor ones. One unnecessary trade rarely destroys an account. 100 unnecessary trades often do. The market offers opportunity unevenly. Some days it provides clear conditions. Other days it offers confusion disguised as opportunity. The skilled trader learns the difference. Can you identify when the market is inviting participation and when it is merely tempting you? That question separates professionals from amateurs more than any indicator ever will. When conditions are favorable, good trades tend to stand out. They require less persuasion. The setup is visible. The risk is clear. The logic is simple. When you find yourself arguing with the market, searching for reasons to enter, or lowering your standards just to stay active, that is information. The market is telling you something, and what is it saying? Wait. Patience is not the absence of action. It is the discipline of selective action. The trader who waits is not doing nothing. He is observing, comparing, filtering, preserving capital and mental clarity for the moment that truly matters. Look back at your own trading journal. Which trades produced the majority of your gains? Was it every trade, or was it a small handful of high-quality opportunities? The answer is usually uncomfortable. A few trades create most of the results. The rest simply create noise. This is why trading less often leads to winning more. Fewer trades mean higher standards. Higher standards mean better entries. Better entries improve risk-reward. Better risk-reward reduces emotional pressure. Reduced emotional pressure improves decision-making. One improvement feeds the next. So the next time you feel the urge to trade, don't ask, "Can I take this setup?" Ask a different question. Would I still take this trade if it were my only trade this week? Because the traders who survive long enough to become exceptional eventually discover that success is not found in constant participation. A trader can improve his strategy, improve his analysis, and improve his risk management, yet still struggle because his standards for entry remain too low. That problem is harder to see than it sounds. The market produces endless movement. Every hour presents something that looks tradable. A breakout appears. A pullback forms. A candle closes with conviction. If you stare at charts long enough, opportunities seem to multiply. But are they truly opportunities, or are they simply movements competing for your attention? The difference matters. The quality of a trade is not determined by how exciting it looks. It is determined by how closely it matches the conditions that historically give you an advantage. The trouble begins when a trader starts treating similarities as equivalents. A setup looks almost right. The trend is there, but not quite as strong. The structure is present, but not as clean. The confirmation appears, but arrives with hesitation. So the trader makes a small compromise. Then another. Then another. Before long, he is no longer trading his best setups. He is trading acceptable ones. Have you ever noticed how standards tend to fall gradually rather than suddenly? Nobody wakes up and decides to take poor trades. Instead, the definition of a good trade quietly expands. What was once rejected now becomes acceptable. What was once considered average now becomes attractive. As standards fall, trade frequency rises, and that increase creates a dangerous illusion. More trades create the feeling of more opportunity. But in reality, the trader is often manufacturing opportunity by lowering requirements. The market has not become better. The filter has become weaker. A strong filter removes uncertainty. A weak filter allows it through. Think about a business owner selecting investments. He does not approve every proposal that reaches his desk. He rejects most of them. Not because they are terrible, but because they are not exceptional enough. Trading works the same way. Every condition you require before entry acts as a filter. Trend quality, structure quality, timing quality, context quality. Each requirement eliminates weaker possibilities. The result is fewer trades, but the trades that survive the process tend to carry greater clarity, and clarity matters. When a setup meets all your conditions, decision-making becomes simpler. There is less debate, less second-guessing, less need to convince yourself. The trade either qualifies or it does not. Can you see how this changes the entire process? Instead of searching for reasons to enter, you begin searching for reasons to stay out. That single shift raises the threshold for participation. The trader who takes every reasonable setup eventually spends his time sorting through endless shades of gray. The trader with high standards waits for situations that stand apart from the background. The market rarely rewards urgency. It often rewards selectivity. This is why reducing trade frequency is not the goal. Higher standards are the goal. Reduced frequency is simply the byproduct. When standards rise, mediocre opportunities disappear first, then average opportunities. What remains is a smaller group of trades that satisfy stricter requirements. The question is not, how can I find more trades? The better question is, what would have to be true for this trade to deserve my capital? Because every filter you add forces the market to prove itself before you participate. A trader can be active every day, take hundreds of trades throughout the year, and still discover that the majority of his profits came from only a handful of positions. That realization surprises people the first time they see it. They assume profits arrive evenly, trade after trade, like wages earned by the hour. But markets rarely distribute rewards that way. Results tend to be concentrated. A small number of trades account for a large percentage of gains, while the majority contribute little, and some merely offset one another. Look closely at almost any successful trading record, and you will often find the same pattern. A few trades stand above the rest, not because they were lucky, but because they captured unusually favorable conditions. The market aligned in a way that allowed movement to develop further than normal. What appeared to be one trade ended up carrying the weight of many. Why is that important? Because it changes how you think about opportunity. If a small number of trades produce most of the outcome, then not every trade deserves equal importance. Some opportunities carry far greater potential than others, yet traders often behave as though every setup is capable of delivering the same result. The market says otherwise. Some moves barely travel beyond entry. Some fluctuate without direction. Some provide modest gains. Then occasionally a trade appears that expands far beyond expectations and leaves a visible mark on the equity curve. Those are not common events, and because they are uncommon, they are often misunderstood. The average trader spends enormous energy trying to extract profits from ordinary market conditions. Meanwhile, the exceptional opportunities, the ones capable of making a meaningful difference, are relatively rare. Can you see the implication? If meaningful results come from a small number of trades, then success depends less on participating in everything and more on being present when those exceptional situations emerge. This is where many traders create unnecessary difficulty. They judge their progress by the number of opportunities they touch rather than by the significance of the opportunities they capture. As a result, they spread their attention across countless minor situations, while the truly impactful ones become just another trade among many. The market does not reward equal participation. It rewards participation in unequal opportunities. Think about a fisherman casting into an ocean. Catching small fish all day may create activity, but one large catch can outweigh dozens of ordinary ones. The value is not distributed evenly across every attempt. Markets operate with a similar imbalance. The returns available in any given period are not spread equally across every day, every hour, or every setup. They cluster. They concentrate. They gather around specific periods of expansion. This means that the relationship between effort and reward is not linear. Doubling the number of trades does not double the opportunity. In many cases, it simply doubles exposure to average conditions. The largest gains often come from identifying the moments when opportunity itself becomes unusually large. Once you understand this, you start looking at performance differently. Instead of asking, "How many good trades can I find?" you begin asking, "Which trades have the potential to matter?" That question shifts attention away from quantity and towards significance. And when you start reviewing your own results through that lens, an interesting pattern often appears. The trades that shaped the year are usually easy to remember. They stand out because they moved farther, lasted longer, or generated returns that dwarfed ordinary outcomes. The account may contain hundreds of entries, but only a small fraction truly altered the final result. One of the most expensive assumptions in trading is believing that opportunity is always available. The chart is moving, prices are changing, candles are forming. Because activity is constant, it is easy to assume that opportunity is constant as well. But those are not the same thing. Movement is always present. Favorable conditions are not. This distinction sits at the heart of selective trading. The market does not offer the same quality of opportunity every day. There are periods when price moves with clarity and purpose. Trends develop cleanly. Reactions behave as expected. Information is reflected in an orderly way. Then there are periods when the market becomes fragmented. Price moves, but without conviction. Breakouts fail. Direction changes frequently. Signals conflict with one another. The market continues to create activity, yet offers little reward for participation. Have you ever experienced a week where every setup seemed to struggle, only to watch the market become dramatically easier a short time later? That shift is not random. Market conditions change because the forces driving participation change. Sometimes buyers and sellers are aligned enough to create sustained movement. Other times they are evenly matched, creating noise rather than direction. The trader cannot control these conditions. He can only recognize them. This is where many people make a critical mistake. They build a strategy around favorable conditions, then expect it to perform equally well under unfavorable ones. The market rarely grants that privilege. A sailor understands that wind conditions matter. A farmer understands that weather conditions matter. Yet traders often behave as though market conditions should not matter. The market disagrees. A setup that performs exceptionally well during periods of expansion may struggle during periods of contraction. A pattern that works beautifully in orderly movement may fail repeatedly in disorderly movement. The setup itself has not changed. The environment around it has. Can you see why this matters? If opportunity varies over time, then participation should vary as well. When conditions are favorable, the market tends to reward engagement. When conditions deteriorate, the same level of participation often produces weaker outcomes. The trader who ignores this reality treats every day as equal. The trader who understands it recognizes that some periods deserve attention, while others deserve observation. This requires learning to read the behavior of the market itself, rather than focusing exclusively on individual trades. What happens after breakouts occur? Do they continue or reverse? How does price behave around important levels? Does it respond cleanly or erratically? Are moves expanding with follow, through or stalling almost immediately? These observations reveal something larger than any single setup. They reveal the condition of the environment. Because market conditions leave clues before they leave results. When favorable conditions are present, constructive behavior tends to appear repeatedly. When unfavorable conditions dominate, warning signs tend to repeat as well. The market often tells you what kind of environment you are operating in long before the final profit and loss statement confirms it. That understanding changes your relationship with opportunity. Instead of assuming that every session demands action, you begin asking a different question. What kind of market am I dealing with right now? That question shifts attention away from individual signals and toward the quality of the environment producing those signals. And once you start evaluating the environment before evaluating the opportunity, you begin noticing that the market itself moves through seasons. Not calendar seasons, but but conditions that expand, contract, strengthen, weaken, clarify, and confuse. The traders who last the longest are rarely the ones who force the same level of participation through every season. A trader rarely damages his results with one bad decision. The real damage comes from what that decision causes next. That is why marginal trades are so expensive. A marginal trade is not necessarily a terrible trade. In fact, that is what makes it dangerous. It usually sits somewhere between a clear opportunity and a clear mistake. It almost qualifies. It almost makes sense. It almost deserves attention. And because it is not obviously wrong, it often gets accepted. But the true cost of a marginal trade is not contained within the trade itself. It spreads. Every decision influences the quality of the decisions that follow. When you enter a trade, your attention becomes attached to it. You begin monitoring price movements, evaluating outcomes, interpreting fluctuations, and allocating mental energy. Whether the trade succeeds or fails, resources have been consumed. That consumption matters, because decision-making is not an unlimited resource. Have you ever noticed how your judgment changes after several hours of watching markets? The first decision often feels clear and deliberate. The 10th decision may not. This happens because every choice carries a cognitive cost. The mind evaluates information, weighs probabilities, manages uncertainty, and processes outcomes. The more often this process repeats, the greater the strain becomes. Now consider what happens when a marginal trade enters the picture. A trade that never deserved full attention still demands full attention once it is open. The market does not care that your conviction was weak. The position is now real. The uncertainty is now real. The monitoring is now real. One unnecessary decision creates a chain of additional decisions. Should I hold? Should I reduce? Should I exit? Should I re-enter? The trade itself may be small, but the decision trail it creates can become surprisingly large. This is where cause and effect begins to compound. A marginal trade occupies attention. Occupied attention reduces mental clarity. Reduced clarity weakens evaluation. Weakened evaluation increases the likelihood of another marginal decision. The process feeds itself. What began as one questionable choice starts influencing the environment in which future choices are made. The trader often assumes each decision exists independently. It does not. Decisions arrive connected. A pilot understands this principle. A small error in judgment early in a flight can alter everything that follows. The initial mistake may appear insignificant, but each subsequent decision is now being made from a less favorable position. Trading operates in much the same way. When your decision quality declines, the effects rarely appear immediately. They emerge gradually through a series of increasingly compromised choices. That is why protecting decision quality becomes so important. The goal is not simply avoiding bad trades. The goal is protecting the conditions that allow good decisions to occur. Can you see the difference? A trader who rejects a marginal opportunity is not merely avoiding one trade. He is preserving mental capacity for future evaluations. He is maintaining the clarity required to assess what comes next. That preservation has value. Every avoided marginal trade removes a potential chain of unnecessary decisions from the future. Fewer questionable positions mean fewer distractions. Fewer distractions mean cleaner judgment. Cleaner judgment improves the quality of subsequent choices. Over time, this creates an entirely different trading experience, not because the market changes, but because the decision environment changes. Instead of constantly reacting to situations created by previous decisions, you spend more time evaluating fresh opportunities with an uncluttered mind. And once you begin viewing trades not as isolated events, but as decision chains with consequences extending far beyond the entry itself, you start to recognize that the real question is not whether a trade might work. A surprising number of traders structure their day around finding trades. Professionals structure their day around being ready for trades. At first glance, those ideas sound similar. In practice, they produce completely different behaviors. When the objective is to find trades, every hour becomes a search. Every chart becomes a possibility. Every movement becomes a potential opportunity. The routine revolves around participation. When the objective is readiness, the routine revolves around preparation. That distinction changes everything. Consider how most businesses operate. A manufacturer does not spend every minute producing products. There is planning, inspection, maintenance, inventory management, and quality control. Much of the work exists to ensure that when the moment for production arrives, the process functions correctly. Trading is no different. Yet many traders build routines that only value action. Time spent analyzing, observing, reviewing, or preparing feels unproductive because it does not immediately result in a position. That mindset creates a subtle problem. If action becomes the primary measure of productivity, inactivity begins to feel like failure. And once inactivity feels like failure, patience becomes difficult to maintain. The professional approaches the day differently. He understands that waiting is not an interruption to the process. Waiting is part of the process. That understanding allows an entirely different routine to emerge. Instead of asking, "What can I trade today?" the focus becomes, "What conditions would justify a trade today?" Notice the difference. One question assumes participation. The other requires qualification. As a result, the day begins with standards rather than opportunities. This creates structure. The trader knows what he is looking for before the market presents it. He knows what conditions matter and what conditions do not. Because the criteria exist in advance, he spends less time negotiating with the market and more time evaluating it. Have you ever noticed how difficult it is to remain selective when no framework exists for selectivity? Without structure, every chart demands a fresh decision. Every movement requires interpretation. The day becomes reactive. A structured routine reduces that burden. The market presents information. The trader compares that information against predefined requirements. If the conditions match, attention increases. If they do not, observation continues. This process may appear passive from the outside. It is not. It is deliberate. A security guard may spend hours watching monitors without taking action. That does not mean he is inactive. It means his role is observation until a situation requires intervention. Trading often demands the same posture. The challenge is that observation produces no visible reward in the moment. There is no excitement attached to preparation, no immediate feedback attached to patience. Yet these activities create the conditions for disciplined participation, because routines shape behavior. When a trader's routine emphasizes constant engagement becomes natural. When a trader's routine emphasizes evaluation and selectivity becomes natural. The routine itself begins influencing the quality of decisions. That is why professional habits matter, not because habits guarantee success, but because habits determine how often you place yourself in situations where sound decisions are possible. A trader who spends every day searching for reasons to act will eventually find them. A trader who spends every day verifying whether conditions deserve action will produce a very different result. The market may be identical. The charts may be identical. The opportunities may be identical. But the process surrounding them is not. A trader can spend an entire month searching for new opportunities while ignoring the full potential of the opportunities he already has. That habit is more common than people realize. The focus naturally gravitates toward finding the next trade. New setups create excitement. New entries create activity. The mind becomes conditioned to believe that growth comes from discovering more opportunities. But there is another path. Sometimes the greatest improvement does not come from increasing the number of winning trades. It comes from increasing the value extracted from the winners that already occur. Think about it. If a trader consistently finds profitable opportunities but repeatedly exits them before they have fully developed, the problem is not opportunity scarcity. The problem is opportunity utilization. The market occasionally offers moves that extend far beyond their initial expectations. Trends develop. Momentum persists. Price continues traveling long after the original objective seemed reasonable. Yet many traders treat these situations as though they are ordinary. As soon as the position becomes profitable, attention shifts toward protecting the gain rather than evaluating the remaining opportunity. The trade survives long enough to become a winner, but not long enough to become significant. Why does this matter? Because outcomes are not determined solely by entry quality. The value of a trade depends on what happens after the position is established. A farmer does not measure success by planting seeds. He measures success by what he harvests. The planting creates potential. The harvest determines the result. Trading follows a similar principle. The entry creates access to opportunity. What follows determines how much of that opportunity is actually captured. This creates an important distinction. There is a difference between being correct and being rewarded. A trader can correctly identify direction and still receive only a fraction of the available movement. The market may continue offering opportunity, yet the position has already been closed. The prediction was accurate. The extraction was incomplete. Have you ever looked back at a chart and realized the move continued far beyond your exit? Almost every experienced trader has. That observation reveals something important. Markets often provide more than traders expect. The challenge is recognizing when additional opportunity remains available. This requires shifting attention. Instead of treating a trade as an event that ends at the first reasonable profit, it becomes a developing situation that must be evaluated continuously. As long as the conditions supporting the move remain intact, the possibility of further progress remains intact as well. Cause and effect become important here. The larger the move develops, the greater the potential reward becomes. The greater the potential reward becomes, the less dependent performance becomes on finding endless new opportunities. One substantial winner can accomplish what several smaller winners struggle to achieve. That changes the economics of trading. A trader who consistently extracts more value from successful positions requires fewer successful positions overall. The burden shifts away from constant discovery and toward effective utilization. Notice how different that perspective is. The question is no longer, where is the next trade? The question becomes, has this trade finished offering opportunity? Those are not the same conversation. One focuses on replacement, the other focuses on completion. The market does not distribute opportunity evenly. Some trades offer very little beyond entry. Others continue developing for far longer than expected. The skill lies in recognizing the difference while the trade is still unfolding. Because once you begin viewing profitable positions as opportunities to be developed rather than simply opportunities to be closed, you start seeing that the relationship between trading frequency and profitability is not always what it appears. Sometimes the path to greater results is not finding more trades at all. The danger of mediocre trades is not that they are always losers. If they were, avoiding them would be easy. The real danger is that mediocre trades often produce mixed results. Some win, some lose, some break even. They generate just enough success to justify their existence while quietly preventing something better. That is why they are so costly. A trader usually notices obvious mistakes. He remembers the reckless entry, the emotional decision, the trade that never should have happened. Those errors leave visible scars. Mediocre trades leave something different. They leave opportunity costs. And opportunity costs rarely announce themselves. When capital is committed to an average opportunity, that capital becomes unavailable elsewhere. When attention is directed toward an average position, attention becomes unavailable elsewhere. When focus is consumed by managing ordinary situations, focus cannot be devoted to exceptional ones. The cost is not only what happened. The cost is also what could not happen. Have you ever been occupied with a trade when a much better opportunity appeared somewhere else? Most traders have. At the time, the situation feels harmless. The existing position appears reasonable enough. Yet the market is constantly presenting alternatives, and resources are always limited. You can only allocate so much capital. You can only monitor so many positions. You can only concentrate on so many situations at once. Because of those limits, every trade competes with other possible trades. That competition is often overlooked. A business owner evaluating investments does not ask whether a project is acceptable. He asks whether it deserves resources more than the alternatives available. Trading requires the same perspective. The question is not merely, can this trade work? The more important question is, does this trade deserve priority? Those are very different standards. A mediocre opportunity may satisfy the first question. An exceptional opportunity satisfies both. This is where overtrading creates hidden damage. As the number of positions increases, Average opportunities begin occupying space that could have been reserved for superior ones. The account becomes crowded. Attention becomes fragmented. Resources become dispersed. The trader remains active, yet effectiveness declines. Not because there is a shortage of opportunity, but because lower, quality opportunities are consuming capacity. Cause and effect begin working against him. More mediocre trades create more distractions. More distractions reduce awareness. Reduced awareness makes exceptional opportunities easier to overlook.